Okay, we're going to pass from Steve to Steve. So, Steve Grasso, I'm going to kick it off with you just because the name was top of mind.
Nice. What have Steve Leisman on more?
Well, listen, 2 big interviews today. Waller made comments. I just don't know if anybody has any visibility, including Jay Powell on down, about where things are going to be, given we don't know what oil prices are going to do, inflation's going to do, tariffs are going to do.
So, when you look at the Treasury Secretary, Bessent, he had mentioned that the Fed is tight, and he used that against the 2-year. So the 2-year and the Fed funds rate. 2 years around 4%. Fed funds rate floating 4.25 or 4.50. Let's call it 4.3%. If that's the benchmark, we're tight right now. And what are the things that increase inflation? What's a third of CPI? Housing. A third of PPI? Housing. So the Fed's rolling off $35 billion off of that balance sheet. Karen knows I've been on this for a while, maybe too myopic on it. That increases an inflated 10-year, increases an inflated 30-year mortgage. So if we're not going to attack that mortgage rate, then I think that the Fed is just going to remain handcuffed. And the Fed, by their nature, are always late. They're always looking at the data. They're always looking at something in the rearview mirror. So to Daly's point, I agree with her, and I agree with Waller. I think you have to be ahead of the curve here. If you were to cut 25 basis points, you just get static right on that 2-year. I think that's probably the thing they should do, and I can't for the life of me figure out why they just wouldn't cut.
They did cut rates last year by 75 basis points.
Now, though.
Yeah. I've sort of come around to your camp of I do think they should cut 25 basis points. I think that we haven't seen the inflation really out of control at all. In fact, it's going the right way, and it seems to be moderating a fair amount. We don't know the full effect of tariffs. But to me, it's starting to be that the Fed is so burned from having thought things were transitory that they will never see anything transitory ever again. It has to be absolutely written in stone before they move, and maybe that's not quite the right thing. How badly could you really screw up if you do cut 25 and then inflation's a little higher? All right, then you wait. You wait longer before you cut again. So I'm sort of coming around to your...
Let's give Tim Seymour a promotion. He's now not only chairman of the Federal Reserve, he's all the Fed. You are all the voting members. Does Tim Seymour cut the Fed funds rate at the next meeting?
First of all, Tim Seymour wants to know if Brian Sullivan said it wasn't his choice to be here at the start of the show, because, I mean, I got to tell you that, this is...
But it wasn't ours either. Don't feel bad.
That's what I thought I heard. All right, I'm chairman of the Fed. Is it a food fight or is it a spat at the dinner table, of which we tend to have both in my house? I think this is all consistent with what we heard from Powell. Didn't he say he was not terribly concerned? Wasn't the implication we're not worried about PC at 3.1%? Didn't he come out and say until the labor market starts to convulse, I'm not that worried about things, and that's why the wait and see. 25 basis points, okay, but why? In other words, I think we know they're going to be late. He doesn't need to be early. So again, what we heard from Waller today was reinforcing what I think is the outer edge of the dovish Fed. But I think Powell said just as much. The fact that they said they weren't worried about inflation from tariffs was enough for me to think that they are slightly dovish.
You know, Carter Worth, what's interesting was a lot interesting because they cut rates last year, as we said. We tend to forget about that. But what's interesting is that we had a small moment for about 2 weeks where rates fell. Like the 10-year was at, 3.5 or 3.6, and everything sort of happened, and then it just shot right back up. Any way to chart the expectations? Because the bond market and the Federal Reserve, I'm not going to say they're saying different things, but they don't necessarily appear to be humming the same tune.
Yeah, the key, what you said, for a brief moment, there's a lot of brief moments, and at the end of the day, and there's just no way around this, Brian, that the yield on the 10-year U.S. Treasury and the yield on the 2-year note are the exact same level right now as they were in the autumn of 2022. It's neither higher.
Isn't that amazing?
It's amazing. Isn't that amazing? Exactly. And so all of the effort and the spinning and toiling as to which way it's going, it's just, it's nothing. It's vanity. And it doesn't matter. One day it will, but it hasn't mattered. And so it's one of the reasons, I suppose, that people are willing to expand the multiple on the general equity market, because rates are neither a problem for being too hot or too cold. And that's why I have that bizarre phrase from the child's story of Goldilocks.